Welcome to another episode of our Private Equity Podcast, where we delve into the world of private equity investments from a modeling perspective. Today, we are going to discuss a critical aspect of investment modeling for private equity investments, the key assumptions that need to be made. Firstly, to understand private equity investments, one must be clear about the underlying objectives, which typically revolve around acquiring a company, creating value, and exiting the investment for a higher value. As opposed to public markets, private equity investors have the liberty to take more substantial ownership stakes, control the company's operations, and implement changes to streamline operations and improve profitability. To model private equity investments, some critical assumptions are needed to create realistic projections about cash flows, operating performance, and potential exit valuations. While the specific assumptions can vary depending on the nature of the investment, some of the key ones are: 1. Acquisition price and funding structure. One of the most important assumptions is the purchase price of the company being acquired. This price will determine the level of equity financing and debt financing required to fund the acquisition. So, projecting the proper capital structure is critical to understand, which determines the cash flows available for investors. 2. Growth rate. Projects the anticipated growth rate of the acquired company, which assumes the growth rate may be above, at or below market or industry level. By understanding the anticipated growth rate, we can model how sales growth will cascade down to profitability and cash flow. 3. Operating assumptions. Assumptions around the company's operating cost structure, revenue drivers, and capital expenditure requirements impact the ability to generate free cash flow. 4. Exit timeline. Assumptions about the planned exit timeline, typically 3 to 7 years, provide insights into cash flows and return outcomes. Time is money in private equity, and exit timing plays a crucial role in modeling timeline strategies. 5. Exit valuation. Assumes potential exit valuations and the type of transaction strategies like sales to strategic buyers or IPO. Assuming the above-mentioned points in our modeling projections serves as a starting point for private equity investors. But it does not stop here. There are other factors as market availability, liquidity, risks, and market sentiment, which can impact potential returns. In conclusion, accurately forecasting private equity investments requires assumptions based on critical and realistic data. Making sound assumptions and continuously reviewing them will assist in creating a reliable investment projection. Our next podcast will dive deeper into modeling valuations for private equity investments. Thank you for listening in.